The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus podcast coming at you presently. And, we just had we're recording this beginning of April 2023. And we just in January had a very large national conference here in my hometown of Salt Lake City, my adopted hometown. And I've been here 23 years, so it's home for sure. And it was really a who's who in the world of multifamily investing and syndication. And it was called the Best Ever Conference. We have no affiliation at the podcast with the conference, but I do like to promote it because I think that it's of huge inherent value to the attendees. Fantastic networking, fantastic speaker lineup. And Zach Happenstall with Rise48 Equity, who was a guest on the show, he was on stage numerous times. And we are lucky enough today to have Rise48's co-founder, one of the co-founders of Rise48, and CFO and COO, Bikran Sandhu. Am I saying your last name right, Bikran?
Yeah, Bikran Sandhu. Yep.
Bikran Sandhu. Yeah, there you go. So, Bikran is like I said, CFO and COO of Rise48 Equity, which is a huge player in the multifamily space, and they've had a lot of success, and we'll get into that in just a minute. But his responsibilities include overseeing underwriting, asset management, and also investor relations for all the assets that they own. As CFO, he oversees accounting, finance, and treasury at both Rise48 Equity and Rise48 Communities. We'll talk about the differences in those. They are in the Dallas and Phoenix markets. That's where they own and source their deals from. And so Bikran, it's awesome to have you on the show. I'm really excited. I had a few people in my world say they got to spend some really good time with you at the conference, and that we absolutely had to have you on the show. So welcome, my friend.
Yeah, no, thank you so much, Tate, for having me on the show. I really appreciate it, man.
Yeah. It's great to have you. So just to start out with, give us a little bit of background into you, sir, and kind of on, especially on the business level, real estate level, and kind of how you got to where you are today doing what you're doing.
Yeah, of course. No, thanks again, Tate. Really appreciate it. I really appreciate being on the podcast as well. So, yeah, a little bit about myself. I don't have like a real estate background. I didn't start off with family doing real estate for a long period of time and me kind of taking the reins in. I graduated college back in 2012 and I went into accounting. I was an experienced assurance associate with PwC, which is one of the large Big Four accounting firms out there in the nation. Audited Fortune 100 companies. Really, between January and March, which was our busy season, worked anywhere between 80 to 120 hours every week, trying to get the financials out, and did that for about three and a half years, and then moved into management consulting. I really liked the aspect of, helping companies become more efficient, establishing processes, procedures, and in management consulting, I really kind of helped companies buy other companies, sell off divisions, or if they're integrating existing companies, kind of help them identify softwares and programs. And from an accounting perspective, how do they kind of integrate their functionality? So I did that for about 4 years. Really enjoyed it. It was a very eye-opening experience, and really kind of helped set my entrepreneurial mindset, where I wanted to see how certain companies performed and how can I kind of leverage that and do something myself.
What industry were you in, or industries?
Yeah, I was primarily in technology, biomedical, and a little bit of real estate at the time. And that real estate side was really kind of what piqued my interest into going to commercial multifamily. Was I had a couple of clients that were REITs, and I was really kind of seeing all the, compensation the REIT managers were making and how these apartment buildings were operating. And I thought, okay, well, if they can do it, I'm somewhat as smart as them. I can try to do it myself too. So that's where I kind of got the bug for real estate and started going in there.
I love it.
Yeah.
One of the key things to highlight before you go forward is just your confidence. Like, that the whole mindset piece is such a huge part of this game, and just your confidence to see somebody else doing what you were doing, even though they were a big REIT, a big institution, but to be able to see what they're doing and say, I could do that. Like, I'm a pretty smart cat. Like I could probably figure this out. And that's such a key ingredient, I think, in going big and taking the leap into your own business.
Yeah, no, definitely. I think mindset's definitely very important. I mean, it looks very complex when you're looking at, financial statements that these REITs put out. But like, if you understand, what the numbers mean, what the terms mean, it starts getting really easy to kind of digest and understand where how the cash flows are working. So, being in that industry for such a long period of time really helped me understand how companies are valued, how companies value other companies, discount cash flow analysis and all that. So I got really kind of cut my teeth on all the analytics side of things over the 8 years that I was in public accounting and management consulting. So came in with a pretty good background into real estate.
Mm-hmm. Yeah. Nice. Yeah. Nice.
And then, so in 2018, I started, my wife, then my girlfriend and I were looking into real estate and thought, hey, we don't want to work, 40, 50 years and build up a nest egg. And when we're like 70, 80 years old, that's when we can retire and do some, passive investing or something. So we really want to kind of build up that nest egg right away, and realized, in order to do that, being a W-2 worker wasn't really going to cut it for us. It's not like we have extravagant expenses or something. It was just more so that we wanted that quality of life that you didn't have to be on call to go to work or, come home late and stuff. We wanted to raise a family, have kids, and wanted to start planning early. So in 2018, I started running some numbers and figured, okay, well, if we want to start augmenting our income, we have to start getting into real estate. So I quickly realized that, single family is great for what it's at, but at the pace that we wanted to go to, we were essentially going to end up at multifamily one way or another. So why not just start with multifamily right away? So we started going to groups like meetups and stuff, local meetups initially, but we realized, a lot of the local meetups are fix and flip or wholesalers that want to just kind of get rid of single family homes. So we started going to more national meetups like the Best Ever Conference or some other meetups in Texas, and really started kind of understanding how the whole commercial multifamily stuff works. So that's how in 2018 we kind of grew from, just being a W-2 mindset to, okay, well, we're going to do this ourselves. How do we get there? And who do we need to partner with to get there?
Mm-hmm. Mm-hmm.
Yeah.
And this was just you and your girlfriend at the time, or wife.
Yep.
Eventually got married, and
yep.
The two of you kind of navigating this together.
Yeah, exactly. And we were reading, a lot of books along the way. We read a book called The E-Myth, where it kind of talks about, I don't know if you've heard of it, but it talks about, how to kind of build out your business and what you want to take competitive advantage into action. So my competitive advantage was I was really good at underwriting. I'm good at analytics and good at investor reporting because that's my background. I cannot talk to brokers. I cannot talk to investors. That's not where my forte was. So that's where we were like, okay, well, what I bring to the table is asset management, operations, and underwriting. How do I get a deal in front of me so we can underwrite it and manage it? And how do we get investors in front of us so that we can, show that, we actually know what we're talking about. So that's where, we were looking out for partners to work with, and Zach Aptostall and Robert Shevchik were the partners that we identified, that really kind of augmented our skill sets. So Zach, as you've kind of spoken with him as well, he's great with investor relations and capital raising. And he's great with brokers. He knows how to work relationships. He understands the importance of relationships. So when we're getting deals in front of us, these aren't just, deals that no one else wants. We're getting the first pick of new deals coming to market. And when it comes to capital raising, he's a wonderkind with identifying investors to work with, capital raisers to work with. So we're very well, we kind of complement each other's skill sets. And then Robert, he's our chief construction officer and designated broker. His background was in architecture and construction. So he's kind of overseeing the physical side of actually doing the renovations that we do to make sure that we're actually hitting our budgets on time for these renovations.
What's his position called? Is he like construction manager or?
Yeah, he's our co-founder and he's our chief construction officer and designated broker. Yeah, so he's overseeing like the property management company's designated broker side as well.
Gotcha.
Yeah, but that's our co-founders, and we met each other in 2018, and in 2019, they had already had a deal under contract at the time. It was called Silver Oaks. It was a 36-unit building, and they were looking for capital for that deal. And I wanted to get into the game as fast as possible, so I took a leap of faith. I underwrote the deal. I looked at the offering memorandum. I did my due diligence, and based on my numbers, the deal worked. So I wired over, my capital amount into the deal, and it was a tenant in common structure. So we weren't raising money from investors at all. It was just Zach, Robert, and my money, and then we had a tenant in common partner that we worked with. But it was just our money, and we wanted to kind of learn, hands-on experience on how to kind of manage these deals. So I was involved on the, the accounting and finance side. I was, helping pay out the bills for the construction side. Zach and Robert were on site working with the subs and with our contractor to make sure that we were doing the renovations on time. And I was practicing, our investor relations side, just because it was the three of us plus our TIC partner. I was sending out monthly or quarterly financial statements to kind of showcase how the property was doing. And it's not complex, it's not, we're not, curing cancer here. These are 60s, 70s, 80s built products. They have not been taken care of. You identify a business plan of, renovating the interiors, taking care of the deferred maintenance, and giving the properties new signage, new marketing, and the deal runs itself. But you just got to make sure you run those steps step by step, and you don't want to, you're not, reinventing the wheel anywhere. So the business plan that we came up with was just value add multifamily investing. And, other operators do the same thing that we do, except we just take it to a little bit higher scale or a higher level of finish. We're not spending, $5,000 a door. We're spending $16,000 a door on renovations, but that is all being taken account on the front end. And our entire process is just dialed in. We take over the asset, we rebrand it right away, we paint it right away. We start working on the amenity upgrades, and we start working on the deferred maintenance. And at the same time, 3 months in, we start doing interior renovations. And that process takes 18 to 12 months or 18 to 24 months, excuse me. And then as we're done with that process is when we'll start going into either selling or refinancing the deal along the way that we do that process.
Mm-hmm. Yeah. Awesome. Lots to unpack there.
Yeah.
So let's rewind for just a sec for when you guys partnered up.
Yeah.
partnerships are a lot like marriages. And I feel like, I've got a great partnership with my partner. He and I have known each other though for 23 years and have been very, very close friends and through that period of time, and have been through a lot together. Yeah. And even we have, tough times, tough conversations, dealing with challenges inside the business, can be stressful and can be even strain the partnership sometimes. Yeah. My coaching to most people on this matter is to partner up as much as you can on a deal by deal basis with people to kind of do, a trial run, if you will, at partnering up on a more permanent basis, like forming an entity, branding, et cetera. So what was your process like in terms of vetting those guys and them vetting you and figuring out that you wanted to move forward with the partnership?
Yeah, it's a great question. We didn't, start off with like, hey, Zach, Robert, do you guys want to just partner up and do Rise48 all together? It was a dating process. So before we, partnered up with Zach and Robert, we were working with a couple other individuals trying to identify deals in the Phoenix market. And what we, realized was we were essentially the boots on the ground. We were doing all the due diligence for the underwriting, and we were visiting the properties, trying to, see whether or not it would make sense to pursue them. And the partners we were working with, they were out of the market. They weren't in the market, and their main additive to that partnership was their experience of buying deals and bringing $1 to $2 million of cash to close the deal. It wasn't anything related to the entire transactional or asset management process. So we just kind of felt, that we were essentially paying someone for their experience, and they weren't really going to hold our hands through the entire process. And we kind of, as we were underwriting deals, we kind of parted ways with some partners that we wanted to work with, just as because we were going through LOI process or trying to do best and finals. And, we just kind of quickly realized that, my wife and I were doing 98% of the work and presenting our case to the partners we wanted to work with. And at the end of the day, it was just not very conducive. So, it didn't work out, but they partnered with other individuals. That's perfectly fine. But that's how we slowly kind of identified Zach and Robert to work with. And at that time, they were working with another person who was doing all of their asset management or their underwriting side of things. So we just kind of, my wife and I just came in and realized, okay, well, they have this other person that's doing all the underwriting. Can we somehow add to this relationship? So slowly, as they were working, as I was identifying deals to kind of pursue, I was looping in Zach and Robert and saying, hey, I underwrote this deal. This is what I think. Do you guys want to get on a call and chat about it? And that's how we slowly kind of started dating, so to speak, on these deals. So the first one we closed together, but then they already had 2 other deals that they had under contract that were closing in May and June with this other partner. And I wasn't involved in those, but future deals, I was identifying deals, I was underwriting them, and I was looping in Zach and Robert and saying, hey, do you guys want to partner on this one or this one? So that's how we dated. Not for a long period of time, obviously. We did deals together in 2019, and then 2020 we formally started partnering together on these deals. Kind of abandoned our personal companies and just kind of started with Rise48 altogether. So it took a while. It wasn't one and done. Essentially, it was We wanted to make sure that we were going to be in it for the long haul.
Yeah, super smart. Got to ask you, where did the name Rise48 come from?
Yeah, so one of the first deals that we bought, I think we had renamed it from Oak Tree to Rise on McDowell. We liked the word Rise a lot. It was I think it had a good name to it. And 48 came from Arizona is the 48th state in the nation, so we kind of combined it to Rise48. So we were initially called Summit Equity back in 2020, but we actually got a cease and desist letter from another Summit Equity that was buying deals in Phoenix. So we had to rebrand it a little bit. So that's how we came up with Rise48 Equity. Now we have a full trademark on it, and we hopefully can't get sued on it in other areas.
Yeah. I like it.
Yeah.
So you guys started in Phoenix specifically, right? That's where you
Yep.
And then the Dallas Fort Worth market, that's somewhat recent for you guys, right?
Exactly. Yeah. So we've bought over 41 deals altogether. We bought 40 deals in Phoenix alone. And before we decided to kind of branch out and go into another market. And the thinking was we wanted to essentially establish a base of operations in one market. And once we knew the formula that worked, that's when we would branch out to another market. So, in 2020, we bought 2 deals essentially, and that was it. Because of COVID, we couldn't really transact a lot. But in 2021 and 2022, we bought 16 deals each year, and really kind of grew the company from that perspective. In 2020, like Zach had his own W2, I had my own W2. We weren't really focused on the deals themselves. It was kind of like a side hobby for us. Okay. And it was interesting, it was fun, but you really didn't make a lot of money out of it. It was, we get an AC fee here and there, but that's not going to last you a long time. So you needed to keep a W2. And then in 2021, Zach and I essentially decided, hey, if you're really serious about this, now is the time to act, because we don't have kids. We're pretty well off financially, where we can like stay 3 to 6 months without any income and we'll be fine. So if you really want to attack it, now is the time. So in April of 21, I quit my day job. I moved to Phoenix from California. And that's when we really started kind of ramping up. So we bought 16 deals in 2021, 16 in 2022, and then at the end of 2021, because we had so much volume, we kind of quickly realized that in order for us to perform at the level that we need to start our own property management company. So we started our property management company, Rise48 Communities, at the end of 2021. So in 2022 was really kind of buying new deals and building up Rise48 Communities to what it needs to be at before we decide, okay, we can take this and then replicate it to another market. So we spent 3 good years in Phoenix before we decided to expand out to other markets.
Yeah. Awesome. It's such a great success story. And that kind of volume is amazing. Like, 4 deals a quarter for, sounds like almost 2 straight years.
Yep.
I mean, I guess the obvious question that probably most listeners are thinking, and certainly I'm thinking, is like, how'd you guys do that? Like, that's really impressive.
Yeah. No, I slept once in 2019. I think that was fun. No, it was, we were just dedicated. We wanted to build this company. We really believed in what we were doing. And Zach was instrumental in trying to get us there, right? He's identifying these deals. I'm underwriting them, making sure that, these actually pencil for what we need to for our investors. And along the ways, I had kind of developed like an org chart of the company and how we wanted to kind of foresee it down the road in terms of the asset management side, accounting side, operations side. And slowly, initially it was Zach, Robert, and myself, kind of our names all over that work chart and everything that we're doing. And slowly, as we're hiring people, we're trying to see, okay, well, what is the most important side of this aspect where we need to hire out? So we hired out our first person that we hired out was our asset management director, Kaylee Chris, who came in and kind of took over the physical side of the operations to make sure our deals were operating and our business plan was being executed. The second person we hired out was Brady, who's our transactions, our acquisitions manager now, but he was a transactions associate, kind of taking all the transactional work out of the picture for Zach. So he was handling all the lender calls, the legal calls, making sure we could close the deals. So we slowly kind of built out from there. Then we hired Jerry, who's our senior who was our senior accountant at the time. Now he's our, accounting manager. And we slowly kind of built out the team to kind of take more of the non-revenue generating deals or activities out of our pocket, to kind of give it to them. And Zach and I would really focus on the revenue generating activities, like finding deals and finding money.
Gotcha.
Yeah.
Super exciting. So what's your team like now? What was your first hire again? Was that an executive assistant?
No, our first hire was our asset management director.
Management director. Yeah. Okay.
Yep. So we started with
operations off your plate.
Oh yeah, yeah. She was our regional director when we first started doing deals. She used to work with our property management company that we had, and she wanted to kind of leave that company and move over into more asset management. And we saw her as like a really instrumental part of the business because she was kind of overseeing all the property operations and and business plan execution, like making sure capex was being implemented. So we hired her on. She was our first hire in March of 2021.
Gotcha. Okay. Yeah. So, listeners, that when you're thinking about adding team members and, expanding those first few positions that Bikran and Zach filled are really kind of key positions in terms of, managing your transactions, managing your operations with your current properties, because that's really, that work set, the activity set is both deserve full-time attention, in my opinion. And, as a team, I think it's really awesome that you guys were able to leverage, those kind of human resources. And it sounds like you did so pretty quickly after you guys formed your partnership too.
Yeah, for sure. Yeah, no, we were hiring at a really like a breakneck pace, really. We were buying deals very fast, but we're also building out the infrastructure because we know that's where you can buy deals every day, but if you don't know how to run them or if you don't have the infrastructure to run them, like you will fall flat on your face very fast. Right. So, we were very cognizant of the fact that we're buying value add deals. We're not working with like one PE partner buying new builds that run themselves. We're taking on risk on our end because we have to implement a business plan. So we knew we needed to have infrastructure in place. So we were hiring at a rapid pace at the right amount of time and at a right amount of people to make sure that as we're buying deals, they're actually operating and they're not, we're not neglecting one side of the business plan.
What was the hardest part about growing that fast? Growing pains and whatnot?
Yeah, it's a great question. I would say identifying the right people on the front end, right? So the first few hires that you have, they're going to be instrumental in how the deals perform, right? So hiring like the top level managers, especially on the director or the VP side, they take a long time to identify. And I think we honestly, I would say like we got lucky identifying Kaylee as our asset management director at the time because she's hungry and she, she's willing to learn and she wants to do what's in the best interest of the company. And we obviously are going to reciprocate. We have very generous, compensation plans and we have good benefits and we have good, PTO plans for the company. So we're willing to give as much as we can get, in terms of our operational side of things. So hiring those first few positions were extremely important and crucial because then we kind of leveraged, our asset management director then started hiring her own individuals under her. She was running the day-to-day plans and we were kind of empowering her to kind of let her, run the show on her end. So we weren't micromanaging. We wanted her to kind of try and fail and try again. And she had that mindset. So it's very crucial when you're hiring that first person or the second person that they understand your business and they understand where you're trying to go, because if they don't have the vision, they're not going to work out. Yeah.
Yeah. And I mean, I'm just so impressed with you guys that you're able to put so much together in such a compressed timeline, like just the deal side alone, the acquisition side alone, the due diligence, the underwriting, you're part of it, all of the analysis and negotiation and LOI writing and all of that. I mean, I know what it takes to get a deal from contract to close. It's a lot of work. And for you guys to have done that so many times and to also be building and hiring out a company and building a team at the same time with all of the things that entails, You guys have been working really hard, haven't you?
Yeah, just a tad. No, we have over 200 employees now in both the companies. Yeah. So it was a rapid expansion, but hiring the right people at the top to kind of let them run their businesses and their departments was very, very critical. Like I could not hire 200 people in 2 years. Sure. I would have lost my mind by then.
Yeah, it's the who, not how, right?
Yep, exactly.
Like you're addressing your company's needs and your company's growth through the hiring the right people and
exactly
empowering them and letting them get to work. So
definitely,
that's great. So what is like? Let's talk about kind of what you guys are up to now. So as far as like a bread and butter deal for you guys, what does that look like?
Yeah, it's it's an 80s value add deal. Depending on the market, Phoenix or Dallas, we're typically targeting a purchase price of 30 to 50 million, depending on the deal and the location. If it's a great location, good mix of units, we might go higher on the purchase price. If it's it's a good location, but maybe more one bedrooms versus 2 bedrooms, we might go on the lower side of the purchase price. But between 30 to 50 million, Phoenix, that'll kind of translate out to maybe around 100 to 200 units. In Dallas, it'll translate to maybe 200 to 300 units, just because of the price per unit. And we're typically targeting value add. So we don't want a fully renovated product that's there just for cash flow. We want to be able to execute a value add strategy that we have in play. So we need to see, at least around 10% of loss to lease in the property, and then we need to be able to increase the rents based on our renovation scope, or at least 20 to 30% on top of the loss to lease. So if we can, make those things work, most likely the deal will pencil. But we've underwritten over 100. We started underwriting deals in Dallas back in December of last year, and we've underwritten over 150 deals already for Dallas. And these are, full-on underwritings where we do rent comp studies. Our asset management team is going out there and actually touring the sites, making sure we can get the actual rents that we're putting in. And the entire process takes about 4 to 6 hours to underwrite a deal. And we've underwritten over 150 deals in the Dallas Metroplex alone. And, most of the pricings that we're seeing, or the whisper price we're seeing, is sellers who still have in their head, that they're going to get 2021, 2022 pricing. So, at the beginning, when we were starting to underwrite, we were like, okay, well, I don't know if I'm doing something wrong, but this is like a 2.5 cap on my numbers. Like I can't buy this. So, we started giving feedback to the brokers, and at the beginning, they were giving us feedback and saying, hey, taxes should be here, insurance should be here. So, we would run that by our insurance broker. We would run it by our, tax consultant in Dallas, and, they would kind of give us feedback as well. So as we're underwriting and we're, improving our underwriting skill set, we're being cognizant of which market we're in. And, when we give feedback to the brokers, we're being very detailed in our feedback. We're telling them what adjustments we're making for pro forma expenses, what our rent comp studies are showing for the average rent per unit, really kind of breaking down the underwriting for them and telling them, hey, this is why this works at this price, or this is why it works at this price, or this is why this deal just doesn't work, for our bread and butter. So we're aiming for 80s value add, 200 to 300 units, 30 to 50 million. And usually, in Dallas or in Phoenix, that's translating out to between a 4.5 to a 5 cap is what we can go in on these deals, and that will usually make the numbers work. But there's not a lot of deals out there like that right now. Yeah.
So in Phoenix, I know like the last 2 years in Phoenix have just been absolutely insane in terms of rent growth, and now I think we're getting some correction there, if I'm not mistaken.
Yep.
How did you model those deals when you were acquiring so many in Phoenix? Are you paying any kind of preferred return? My impression is that the price points were just so high that the cash flowing a property to the degree that you could pay a preferred return would be pretty difficult. Was that your model, or did you have a different kind of model?
Yeah, no, we've always done a pref. So ever since 2019, starting in 2020 when we started Rise48, we've always done a essentially some sort of pref on our deals. So the way it works is we'll essentially offer like a 7% or an 8% preferred cash on cash return and then do a split afterwards. But the deal would not pay out the entire 7% right away. So we'll start off around 3 to 4%. And then whatever we have not paid out, that would get accrued and that would get paid out next year or when we sell. So let's say, we have a 7% pref with a 70-30 split on a deal and someone invests $100,000. And let's say we hold it for 3 years and we pay out 4% per year. So we've paid out 12%, but we really should have paid out 21% in total based on the 7% pref. So when we go to sell the deal, we have to pay out the 9% that we haven't paid out. Then we return capital and then we do profit splits. So that's how we modeled every single deal. So we tell investors, cash flow is going to be light because these are value add deals and we're not going to BS you into, thinking you're going to get 7 or 8% cash on cash right out the door because that's not a value add deal. When we do turn the property around and stabilize it, that's when the pref will catch up. And if we don't catch up all of the pref by the time we're ready to sell, we're going to catch you up upon sale with the proceeds on sale.
Yeah. Yeah. So it's just a matter of conditioning your investors for, so They understand the plan, they understand when they're going to get paid, how they're going to get paid. And it's fascinating. Just to be real, like a lot of syndicators right now are struggling, right? Because they used whatever fixed rate or floating rate debt with adjustable rates and short timelines and that sort of thing. How have you guys protected yourself in this current climate?
Yeah, no, that's a good question. So, ever since the beginning, we always underwrote that, if we were going to take on variable rate loans, that those loan interest rates would increase. So back in 2021 and 2022, or at least the beginning of 2022, as we had deals under contract, we always projected that rates were going to go up anywhere between 50 to 100 basis points every year. Now, obviously in 2022, rates went up by 450 basis points in a year, so we didn't project that in our underwritings. But what we did do was we raised a lot of operational reserves. We knew these are value add deals. So the reason we raised the money, so let's say we had we had to raise like $20 million on a deal. We raised $22 million on that deal, kept that $2 million in the property's bank account in case anything was to happen when we took over. And if it didn't happen or something, there was no issues at the site, we would slowly kind of give that money back to the investors. That was our entire pitch the investors as well, was like, hey, we're going to over raise on this deal, but understand that the extra money is not going into like Zach and my pocket. It's going into the deal. It's going to stay over capitalized at the deal level. And if we don't need it, we'll give it back to the investors. So that money was there for the issue side of things. We never had any issues at the sites. We had one building where we bought, in March of 2022, and then within a month, 32 units went on fire and burned down. And it was a 272 building. Thankfully, no one got injured. But, right now we have 240 units online, 32 units offline, but the insurance is kind of helping build those units back up. So it's not a significant issue, but, those are the reasons we had kept the excess capital on the sidelines, was because if something like that happened, we could front the money if we needed to get the process started. We didn't have to do any sort of capital calls. So the entire time we've been raising excessively on the deals, and we've been modeling in the interest rate increases. That helped out somewhat, from an underwriting perspective, as the interest rates shot up pretty significantly. But at the end of the day, interest rates for us went up by, from 0.05% to 2% where our caps were at. So that interest rate expense went up pretty significantly as well. So based on that, in 2022, we started changing our underwriting a little bit, where instead of buying a cap at, 2 or 3% out of the money, meaning that if the interest rates today were at 2%, we'd buy a cap at 4%. We started buying the caps at 2%. So like right where the interest rates were at, caps were enormously expensive, and there still are, for the costs that we're increasing. But what's happening is we're having to essentially offer a lower purchase price to the seller, and take the difference and put it into the cap. So a deal which, might pencil at $50 million on a normal cap rate pricing, we're only offering 47 or 46 million and taking the rest of the money and putting it towards a cap purchase. And that's how we're modeling it. For the past deals, all our deals are cash flowing positive. The deals that are still in the middle of being renovated, they still have some negative cash flow on their end, but that's expected, based on the deals themselves. We're going in and renovating them pretty significantly. We're getting the rents that we need to, but there's going to be some short-term negative cash flow. But we have reserves that we've always raised to take care of the property at that level. We've paused distributions on a few deals in 2021, and we've been very transparent with investors. We've told them, hey, rates have gone up. We'd never projected rates to go up so significantly in a year, but we have reserves. Deals are cash flowing positive. There's no issues. The problem is we can't keep distributing at the level that we need to keep up with the pref. So what will happen is we'll have to slow down the distributions. Your pref will continue to accrue, meaning that when we do sell, we'll catch you all up. But then, we'll have to pause some distributions here and there. We've never done any capital calls. We never had a need to. We're not doing any this year. We're not doing any next year, because we've always modeled in these excessive reserves that we have at the property level. Worst case scenario, we'll pause distributions and, not pay out the distribution, but we're never going to ask investors to put in more money.
Yeah. So how did you know, was there a formula or a metric on how much extra in reserves to raise when you guys were doing those raises?
Yeah, we typically targeted around 10% of the total raise was what we were trying to do. And I was modeling it in. Obviously, if you go a little too excessive, you'll dilute the returns a little too much, and then the deal wouldn't pencil. But I think the sweet spot was around 10% of the total equity raise would go into the property's bank account and sit there, just eating dust essentially, but there as a reserve if we needed it.
Sure. So smart. And for listeners, like, the worst thing you can do is underfund a deal. And if it sounds like I'm talking from experience, it's because I probably am. It's painful, and you've got to figure out either shoveling your own cash capital into the deal, or doing a capital call or whatever. And the reality is, that we kind of had a black swan event in the debt market. And that was unforeseeable for most of us anyway, to the degree that it happened. And that sort of thing happens, but you also just have general overruns sometimes with CapEx, and maybe your vacancy doesn't get eliminated as quickly as you thought. Maybe your rent projections came in a little bit high and you're not able to get the rents that you got. Like, there's a lot of variables that can lead to needing funds that you didn't necessarily think you were going to need. And so do yourself a huge favor, listeners, and model just like Bikran and Robert and Zach did, model in your reserves and make them substantial. I mean, 10% substantial. That's a lot.
Yeah. No, we've always been very conservative in our closing costs and our reserves that we raise. So, it's very easy. And especially when you get, very emotionally attached to a deal, it's very easy to start cutting back some things just to make the deals pencil a little bit better. But, one thing that I kind of do on my end is I do not visit the sites. Zach is the one who goes on and tours the properties, because, brokers can really sell a deal very well. And, I don't want to be in a situation where I'm touring the site and I really fall in love with it, and I kind of disregard some of the obvious red flags here and there. So I'll underwrite the deals. I'll look at the numbers and I'll tell Zach, like, hey, Zach, I know that you like the deal. It's a great location. This is what we can pay for it. I'm not going to change my payroll number from $1,400 a door to like $1,200 a door just because that'll make the deal work or something. Because I know I'm not going to hit that number. I'm going to be underwater on my budget side right away if I try to just make the deal pencil just because it's a great location or something.
Yeah, you're not doing yourself any favors by doing that, or Zach for that matter, your partners, so your investors. Okay. So last questions. Does Zach handle most of capital raising for you guys, investor relations and whatnot?
He'll handle, yep. He'll handle most of the capital raising. I'll raise money here and there, on from my set of investors that I've kind of built up relationships with over time. But Zach does say 85% of the total raise.
Yeah. Awesome. I lied. One last question. So, just kind of to circle up with all the wisdom that you have gained at a young age. I don't know how old you are, but you look pretty young, Bikran, and I know you guys are young go-getters. What would you say to the multifamily investors, maybe done a few deals, maybe that 36 unit, something like what you guys did, and wants to scale the way you guys did, or at least, even half of what you guys did? What are maybe a couple key points that you've taken from that experience?
Yeah, that's a great question. So I can tell you that this is not a individual game. This is a partnership game. If I was trying to do it myself, I can guarantee you and I would not be sitting here speaking right now. I maybe have 2 or 3 deals that we would have bought, and just by myself, and we definitely would not have bought anything else. I think you want to leverage your competitive advantage and the partnership that you establish. So if you're really good at relationships and you can raise money, perfect. Find someone who's really good at underwriting, or find someone who's really good at raising capital if you're focused on broker relationships. You don't want to, come in and be the asset manager working with another strong asset manager. You might like them a lot. They might be a great fit for your, friendship level, but you're not doing yourself a favor and trying to work with someone who has the same skill set as you. And the second thing I would say is get your hands dirty. If you're out of state doing multifamily, like I was doing all the accounting and finance side, which you could do remotely. You don't have to be on the site to take care of the accounting or finance side, as long as the transactions are getting entered in correctly. But if you and your partner are, say, both located in California and you're buying deals in Arizona, someone needs to be the boots on the ground to see the site, to see what's happening. Zach and Robert, the 36 unit deal that we went after, Zach and Robert were on site on a weekly basis to make sure that the contractors were out there doing the job. And whenever I got the invoices in, I would confirm with them that, hey, the work was actually done before we would issue any payments out. Doing any, bank transfers and everything, that was easy for me to do. But I always had Zach and Robert tell me that the work was actually done before we cut any checks on that end. So get your hands dirty and find the partners that augment your skill set, not someone who just duplicates your skill sets.
Yeah. So we sometimes talk about that as like knowing your superpower on the show. So your specialized knowledge, your skill sets, your competitive advantage, as Bikran called it. You want to, like you said, you want to double down on that stuff and really accentuate it and leverage it the best you can. So Bikran, awesome stuff, man. Thank you so much. If people want to learn more about Rise48, the investment opportunities you guys have, and about everything that you're up to, what's the best way for them to find you?
Yeah, I think the best way is on our website, rise48equity.com. So it's the word rise, the numbers 48, and then the word equity.com. And if you can go in there and check out the deals that we have and what we do. If you got to reach out to me personally, my email is Bikran@Rise48Equity, and I think I'll be available in the show notes. But feel free to reach out. And I think on our website there's a invest with us button or something, or rise48.com/invest. And you can go in there and set up a call with Zach, Robert, or myself, and we can chat about, what deals we do and how you can get on our investor list.
Awesome. Great stuff. Well, listen, we're here for you guys at Greenlight. If you ever need anything in Utah or Columbus, Ohio, or Oklahoma City, those are where we live and work. But we certainly wish you guys all the best, and it'll be awesome to continue to stay in touch and watch all the success that you guys have.
Yep. No, likewise. No, thanks so much, Tate, for having us, and really appreciate it, man.
Yeah, appreciate you and appreciate you being on the show. So, listeners, this has been the Bikran Sandhu, and awesome interview. Super grateful, and hopefully you guys got a lot out of this too. Just a lot of good actionable points and a lot of good perspective. So if you did, we love if you leave us a rating and review. That helps the show a lot and gets us in the right algorithmic mode, so to speak. So yeah, we will see you guys on the next episode of The Apartment Gurus. Take care, everybody.
Awesome. Thanks, everybody.
This has been The Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.